Now, looking at the investment trust structure, I'm wondering how you're using it to generate strong track records of dividend growth. I'd like to ask that to Julian.
Sure. Well, one of the really fantastic features of investment trusts is the ability to use reserves, particularly revenue reserves, to smooth dividends. So we have to pay, as investment trusts, 85% at least of our net earnings to shareholders in the form of dividends, but we can keep up to 15% each and every year. And over years, of course, that can accumulate and build up to be a useful pot, which can then be used in more difficult times to supplement the income. And that's a power that all investment trusts have and could use. Some have used more than others. And certainly across the 31 years of CT UK, we have built up reserves. Our reserves are almost 90% of the annual dividend. But we have dipped in many times. So across the last decade, we've used reserves 3 times to supplement the income that we've received naturally, and in order to keep our dividend growth going. So it is an enormous strength to have that revenue reserve. And more recently, companies have also been able to use capital reserves to make that distribution. And that really is a big contrast to the open-ended sector. And I think for anyone looking for a steady payment, of course, there are no guarantees, but perhaps planning for a pension, retirement, having that safety net of the reserves to underpin the dividends, I think is a very useful thing to have.
It certainly is a very useful thing to have. And we have 20 investment trusts, which are our dividend hero investment trusts, which they've increased their dividend every year for more than 20 years. And of course, your trust with 31-year record of consecutive dividend increases is one of them. So that is a very useful benefit. Moving on, Ian, what about you? What do you think are the benefits of the structure when you're generating income?
Very well demonstrated, I think, by this year, the board of Temple Bar decided to change the dividend policy of the trust. And this was in recognition of the fact that an increasing number of companies are now splitting their distribution to shareholders between dividends and share buybacks. And a dividend obviously goes to the revenue account of a trust. A share buyback does not. It goes to the capital account. And so what the board said was that in the future, they are going to pay a certain amount of income out as dividend, and then they're going to supplement that with a payment out of the capital side of the trust in recognition of the fact that an increasing amount of the return to us is coming through share buybacks. And the actual impact that had was it turned a 3p quarterly dividend into a 3.75p quarterly dividend, and it basically took the yield on the trust up from about 4% to about 5%. So I think that was, quite an innovative way to use the trust structure to ensure that the money is still being returned to the trust shareholders.
Absolutely, and a really quite material impact on the dividend from that. And of course, you couldn't do that with an open-ended fund, could you?
No, not at all.
Excellent. And Thomas, how about you? What do you think are the benefits of the structure when you help you generate income?
Yeah, I'm quite a glass half full person, so I like gearing actually. And I know we do have lots of discussions about gearing, but this is something that you can do in a closed-end vehicle that you cannot do in other types of vehicles. So I think this is a really, really important area where we can add some value. And when I say glass half full, look, I mean, actually, it's not wishful thinking. This is actually based on data that if you go back 5 years, 10 years, 20 years, we talked about the dividend hero status. Look, it's true to say that part of that has been driven really by the stock picking that we've done, but it's also because the market itself is producing this wonderful dividend growth. And so over time, we get dividend growth, we get capital growth. And if we add some gearing into the mix, actually that just propels us even faster. And it allows us to build up more revenue reserves. It allows us to actually take advantage of this positivity that we see in equity markets. I speak to my fixed income colleagues. They just don't have that. Of course, the clue is in the title, fixed, that we have growing dividends. And if we add some gearing in, and at the moment I'm sitting on gearing of about 11.9%. So that's typically we're between 10 and 15%. And so actually, I'm always mindful. We always have the discussion at the board, how much gearing do you think is appropriate given the signals that we're getting on the market, on earnings, on valuations. So it's a thoughtful discussion that we have, but that provides us with a kicker. And of course, we're yielding 6.1% in Aberdeen Equity Income. That doesn't mean that the median company or the average company in the portfolio needs to yield 6.1. Because we've got that gearing, it means that actually we could be looking at stocks with a much lower yield, and overall we're still generating that very nice dividend yield for our shareholders.
Yeah, gearing over the long term is a real boost to performance. And as you've explained, that can be dividends as well as, capital and growth. I'd really like to thank our managers for joining us today. It's been great to hear their views. I'd like to emphasise we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thanks so much for watching.